All right, let's dive into the economic outlook for 2026. And it's a really fascinating picture because it's a story of these two huge conflicting forces. On one side, there's this incredible promise, but on the other, there is some serious pressure building up. So today, we're going to break down exactly what that means.
So this is really the big question we're trying to tackle. After all the uncertainty we've been through, are we finally about to see that big rebound? Or are there some new, maybe even bigger risks just around the corner? The truth is, the data is pointing in two completely different directions.
And look, this slide just lays out that conflict perfectly. You've got RSM projecting that the US economy is actually going to accelerate, growing at 2.2%. But then you have the World Bank coming in and saying, hold on, because global growth is slowing down. So how can both of those things be true at the same time? That's the puzzle we're here to solve. Okay, so our first stop in this investigation is precious metals. We are seeing a massive surge in interest, which, tends to happen when things feel a little uncertain. But the question is this just market hype? Or is it a genuine flight to a safe place to park your money? Before we get into the numbers, please don't forget to subscribe to my channel, turn on notifications, share, and like my videos. This is not investment advice. Thank you. Now check this out. Goldman Sachs has come out with a pretty wild forecast. They're predicting gold could hit $4,900 an ounce by the end of 2026. They're pointing to huge demand from central banks and, of course, the widespread belief that the U.S. Federal Reserve is going to start cutting rates.
That is a number that definitely grabs your attention, for sure. But if we only focus on gold, we might be missing a more interesting, more subtle part of the story. There's another metal that really deserves a closer look right now.
And here's where it gets interesting. This slide really breaks it down. Gold's story is the classic one, right? It's all about Fed policy and investor jitters, a safe haven play. But silver kind of has this dual personality. Yes, it's a precious metal, but it's also a crucial industrial metal. Its demand is being fired up by the green energy transition. We're talking about a key component in electric vehicles and solar panels. Morgan Stanley even calls this a huge structural transformation. So the story isn't just about financial markets, it's about massive, real-world industrial changes.
So let's zoom out from metals to the wider global stage. Because that promise of strong U.S. growth, it's running right into a wall of pressure on global trade. We're seeing this trend that analysts are calling resilient fragmentation, which is just a fancy way of saying that geopolitical tensions and tariffs are literally reshaping how everything moves around the planet. And it's not just one thing. Both the World Bank and RSM are waving red flags about these global headwinds. You've got rising trade barriers, you've got this constant policy uncertainty, and then you throw in geopolitical flashpoints, particularly in the Middle East, plus the drag from existing tariffs. Well, you've got a recipe for some serious friction in the global system.
And this isn't just some abstract risk. The Dallas Fed actually crunched the numbers to show us what this could mean for our bank accounts. Look at this table. If things stay relatively calm in the Middle East, the impact on inflation is tiny. But if the conflict flares up again, that could add almost 3/4 of a percentage point. And in a worst-case scenario, like the Strait of Hormuz closing, we could see inflation spike by 1.28 percentage points. That's a huge, very real impact on the cost of everything.
So all of this brings us to the U.S. Federal Reserve, which, frankly, has to navigate this ridiculously complex situation. The market is basically betting the farm on the Fed cutting interest rates, but it is a genuine tightrope walk for them. And that inflation risk we just looked at, that makes their job a whole lot harder. Right now, the consensus forecast is pretty clear. Everyone expects 2 to 3 rate cuts, which would bring the policy rate down quite a bit by the end of 2026. And this is really the cornerstone of that optimistic promise scenario we talked about, because lower rates should, in theory, boost investment and the markets. Okay, so that sounds great on paper, but we have to ask a tougher question. Are these rate cuts a tide that's going to lift all boats equally? Well, the data suggests that the reality on the ground is way more complicated and divided. And this leads us to this really powerful idea of a K-shaped economy. It's the perfect way to describe what's happening. You have the top arm of the K going up. That's the part of the economy that's doing great. And then you have the bottom leg of the K going down. And that represents everyone who's struggling or getting left behind. This chart just visualizes that divide perfectly. On one side, you have high-end consumers who are riding high on what's called the wealth effect. Their assets are worth more, so they feel richer and spend more. For them, rate cuts are fantastic. But then on the other side, lower-income households are just getting squeezed. As RSM points out, inflation is still expected to be at or above 3%. So any raise they get is basically being eaten up by the rising cost of living.
This split is what makes the whole economic picture so tricky.
So, what do we do with all this? How do we put it all together? We've got a strong U.S. outlook that's clashing with global pressures, and we've got this divided recovery right here at home. It's pretty clear that navigating 2026 is going to take a little more thought than just being optimistic or pessimistic. I think this quote from Morgan Stanley just hits the nail on the head. It really captures the right mindset. In a world this complex, opportunities aren't all going to be in one obvious place. They could pop up from anywhere, whether it's the green tech boom lifting industrial metals or shifting trade patterns creating entirely new supply chains. So really, the big takeaway here is this. 2026 is not the year for a passive, set-it-and-forget-it kind of strategy. The split between domestic promise and global pressure means that success is probably going to come from being careful, from active selection. It's about finding those specific assets that can actually thrive in this very unique K-shaped world. And that really just leaves us with one final question for you to think about. In a world full of conflicting signals, the real challenge isn't just finding information, it's about finding clarity. Thanks for joining me for this breakdown.